In this video, we're going to have a look at the balance sheet and in particular ratio analysis, a couple of ratios as measures of financial stability. Now we're shifting to solvency. We've gone from liquidity in the short term to solvency over the longer term. So instead of looking at simply current assets and current liabilities, we're now going to be looking at total assets and total liabilities. And this is about funding. It's a measure of, it's about gearing. Gearing is your level of funding that you may have from owners compared to external debt. If you're geared, then you have high external debt. You're geared up. You've taken your piece of equity, borrowed a whole lot more money, and that's what's called leveraged or geared up. And this solvency is a measure of gearing, and it's your ability to meet all debts, okay? Your non-current liabilities as well as your current liabilities. So it's both short and long term, but a solvency extends from the long term. But of course, before you have that long-term problem, you will have a short-term problem. The first, or the ratio we're going to be looking at here regarding solvency is the debt to asset ratio. The debt to asset ratio divides our total liabilities by our total assets, and it's expressed as a percentage. So it tells us the percentage of assets that are financed by external funds, okay? So if we divide our liabilities by our total assets, that tells us how much of our assets are financed by external funds as opposed to internal funds. Internal funds means we are using our equity. That means it would be equity funded. External funds is debt funded. And the debt to asset ratio indicates reliance on outside finance, for example, banks, rather than your own money. And it also indicates who has the major control over the assets of the business. Because if you are highly leveraged, if you've taken your assets and give them as surety to the bank so you can borrow more money, then the bank has a significant amount of control over your assets. You can't sell them if the bank has them as a mortgage or as some form of security over the loan that they have given you. You are not free simply to sell those assets from under the bank if you have provided them as security for the money that's been borrowed. Looking further at the debt to asset ratio, the higher the ratio, the higher the gearing. The higher the gearing, the higher the risk. And the higher the risk, the higher the returns. That's what entrepreneurs want. That's what business owners want. We all want higher returns. And entrepreneurs are prepared to take higher risks. And therefore, they will gear up. They will leverage their bit of equity with as much borrowed debt as they can, usually. However, creditors don't like it that way. They would rather that you have lower debt to asset ratio and a higher amount of assets per borrowed money that you have. Banks are risk averse. That means they don't like taking big risks, and they don't like you taking big risks with their money. So they prefer the ratio to be lower. Better for all involved, they say. Not so much the business owner, but it's those creditors who are involved with the firm. The lower the debt ratio means more safety to creditors in the event of liquidation. If you go bankrupt, insolvent, that's when your liabilities become greater than your assets. You are then insolvent. You have to cease trading immediately and probably look to winding up or liquidating if you cannot, if the liquidators cannot see a way to trade out. So you want greater assets and you want lower ratios. A ratio greater than 50% debt to asset ratio is considered more highly geared, okay? And less than 50% would be considered lowly geared or less geared. And this is a measure of a business's long-term financial stability, okay? That stability is considered risk. Taking risk might bring some instability, and so we want to have a modicum of financial stability. All businesses want stability, but they all want growth, and it's a trade-off. You can't have stability without risk. It's like sailing. If you want to sail fast, you need strong wind. With strong wind comes big waves. With big waves comes instability, okay? It's all a trade-off. You can't have calm waters and strong winds. Let's have a look at the debt to asset ratio of these two businesses. Exercise 23. Calculate the debt ratio of Taipan Traders and Parrot Partners. Taipan Traders has assets of $150,000 and liabilities of $60,000. You should always have assets greater than liabilities. If not, you are insolvent. Quick, call the liquidators, call the accountants. You are in big trouble and you must cease trading. So because you have equity in this business, your assets are greater than your liabilities. The debt ratio is total liabilities over total assets, expressed as a percentage. 60 over 150 is equal to 40%. That sounds okay. Parrot Partners has much smaller business here. Total assets of only 30,000 over total liabilities of 20. Debt ratio is total liabilities over total assets. The smaller over the larger. 20 over 30 is 67%. How does that sound? What observations can be made about the debt to asset ratio for these businesses? Taipan Traders has a debt to asset ratio of 40%. What does this mean? This means that 40% of assets are financed from external sources, from debt as opposed to equity. Is this low or high geared? Well, this is considered low geared because the ratio is below 50%. What does this mean for the business having control over the assets? Well, business will have more control over the assets because it has a greater share of ownership in the assets. Is remedial action required? No, no remedial action is required for Taipan Traders. What about Parrot Partners? Parrot Partners has a debt to asset ratio of 66.7%. What does that mean? That means that 66.7% of assets are financed from external sources, that is debt as opposed to equity. Is this high or low geared? This is considered highly geared as the ratio is above 50%. What does this mean about control over assets? Well, this means that creditors would have more control over the assets than the business. Is remedial action required? Yes, you would recommend that remedial action could be taken to reduce the ratio. What are some problems arising from too high a debt ratio? Okay, if your debt ratio is too high, it can limit your decisions about your assets. You can't just sell an asset because if it's used as security for the loan, then the bank has a say on whether you can sell that asset or not. Okay, so it limits your ability to make decisions about your assets. If you have higher debt, you have higher interest repayments, and this can put downward pressure on cash flow and net profits. Obviously, on net cash flows, you require some of your cash to go out to the bank to cover your interest repayments. And as for net profits, you need to take care of your interest repayments as well. Oftentimes you'll look at the books and you look at your profit and your net profit before interest because it's a choice to have them financed from external sources. They could have been financed from internal sources, and whether they're financed from internal or external doesn't make an initial impact on your net profits, but you have that net profits and then you have your interest payments. So it puts downward pressure on your profit. Your control over assets. You lose control over the assets. Before we said that it limits your ability to make decisions, so you're starting to lose control. If you do not make your interest repayments, if you do not pay your creditors, they come knocking and they can repossess your assets. If you've got a machine, they can repossess it. If you've got a fancy car, they can repossess it. Then they make a TV show about it. What about your house? The banks can take your house if you cease to make mortgage repayments. So they have control. That's what that mortgage contract gives the banks. It gives them security. The asset you have is required as security given to the bank. And so they have control over those assets if you do not make your repayments. And then, of course, there's a possibility of insolvency. Insolvency is where your liabilities become greater than your assets. You must cease trading immediately, call the accountants in, and it's not all over by the shouting. But if you can't trade out, and they will determine that, then you will be wound up, you will be liquidated, and you will be closed for business, closed forevermore. Don't do that. So what are some remedial actions that can be taken to reduce the debt to asset ratio? They are refinance your loans. You may not be able to refinance to a lower interest rate. You are already in a high risk category, and so the bank may deem that that interest rate is commensurate with the risk. But you may be able to refinance it over a longer period of time. Over a longer period of time means your repayments will be lower. You could undertake measures to increase sales and cut costs to improve profit, and then you can repay debt. That's your role in business. You want to make profit to maximize profits, and so you may need to work at increasing your sales. You may need to cut some costs. Costs can always be cut. A wise man once said, you can always cut 5% out of your costs. You may need to make an injection of capital. As a small business owner, you may need to make a capital contribution if you have it. If you are a public company on the stock exchange, you can do a capital raising by issuing shares and raise some capital that way. So in summary, we need to calculate your debt ratio. You need to interpret your findings. What does it mean? Is it high or low geared and why? Is that 50%? And does remedial action need to be taken? You need to know your potential problems from having too high a debt ratio, and you need to know what remedial actions there are that can be taken.